Hi everyone, and welcome to another episode of Value Investing Talks, where we discuss finance, business, and value investing. I'm your host, Eugene Alexiev, and I bring with me over 10 plus years of experience in running my own businesses. Some of them were sold, and some of them I run nowadays. Additionally, I am the founder of numfin.com, a comprehensive stock research tool for public companies. At Numfin, we cover over 60,000 companies listed on 70 plus stock exchanges worldwide. Our platform provides information in 25 languages, offering insights into finance, management, company ratios, and other essential facts. You can find the link to our website in the description. It is also important to note that all the information shared on this podcast is intended for educational and entertainment purposes only. We do not provide financial advice. So sit back, relax, and let's dive into the world of investing. And today our guest is Whitney. Hi Whitney, how are you?
Good. How are you doing, Eugene?
So far, so good. Could you please tell a little bit more about yourself to our listeners and audience in case people just don't know you?
Yeah, sure. I'm a searcher, so I'm searching for businesses to acquire right now. And my background, though, is very much in a different world. My background is in chemistry, but over time, kind of realized that wasn't going to be a good fit for me, and spent a lot of time reading books and educating myself on different options out there, and really felt that the idea of investing in businesses, smaller businesses, was a really excellent route to go. So that's what I've been doing.
I see. And why you just decided to go in this private equity? Because obviously there are different types of investing right now. You can invest in public equities, in real estate, or just other types of assets. Why did you choose exactly small businesses?
That's a really great question, and I definitely pondered in all three of those different investment vehicles that you're mentioning. So, I mean, starting off with the idea of buying stocks and kind of going the classic route that I think most people are introduced to through 401ks, for example, or value investing, where you buy stocks and keep them for a long time. Those are great options, but you can't use debt to finance those options. So you're very limited with what is in your bank account at that time, and you really don't get to see anything exciting per se. You don't get to make a lot of money if you don't have a lot of money to begin with, in that vehicle, in my opinion. And so that's a reason that I didn't really want to go that route. It's great for retirement. Yes, you get to, build your portfolio up and take it out when you're 65 or 70. But once you take it out, that's it, unless you're taking out an interest-based approach. But that money's gone. And so real estate then is a way where you can take money out and then continue to keep having cash flow. So that is a great investment vehicle. But again, you're running back to the situation where you sort of need a lot of cash to purchase a real estate. And then you're only getting a little bit, I feel like, every month. And then the money really in real estate is obviously in the equity that you build up from 5 to 7 years. And you can raise money for purchasing real estate, and that has a lot of benefits. But it's a very crowded market, and there's a lot of people doing that right now. So finding a deal in real estate that really makes a lot of financial sense is ultra competitive in my personal opinion. And it's just not as interesting to me as going and looking at all these different businesses. And I think the returns on businesses are just a lot more impressive than most people are aware of. And yes, you do have to put a little more sweat equity in. It's not quite as passive as a real estate investment, or obviously as buying stocks. But a lot of times you'll see, almost, if you're willing to put a little bit of work into the business, you can see a 100% return on your investment within the first year. And I just think that's really unheard of in any other investment vehicles out there. So that's really the appeal, in my opinion.
Yeah, I totally agree with you, because I recently spoke with different types of investors who invest in real estate and run hedge funds. And it's really difficult to get such type of returns as you described. So basically, if your fund has the returns of like 100% per year, most investors can just fear to invest in you, because sometimes this can be higher risk asset classes, and your strategy can be so proven. In terms of private businesses, yeah, I agree that in some cases that can be much profitable than investing in the real estate or other types of assets. And speaking about the private equity deals in general, do you think that it's less risky if you understand the business and investing in the right type of businesses than other types of asset classes?
Yeah, I mean, you bring up a really great point, which is that yes, the returns are better, but there is more risk associated with buying a business. And if you have a background or experience in it, I think that's a great way to decrease your risk. But I think for a lot of the people, most searchers don't have background in the smaller businesses, because most of the smaller businesses are more leaning towards kind of a blue collar industry. So HVAC is like a very hot topic right now. Like that's a big one that everyone likes to talk about. And kind of the gold term there is just the fact that HVAC, for example, has reoccurring revenue, and that's really going to de-risk you a lot, because every single month you can count on a certain amount of revenue coming in from maintenance contracts. And there's a lot of other businesses out there with a really nice reoccurring revenue, and they aren't typically like SaaS businesses is the first one you're going to think of, right? Software ones. Yeah. But there's a lot of kind of these businesses that are generating $1 to $4 million a year, and they do have that reoccurring revenue there. It's not the full amount, of course, like it doesn't make up all of the cash flow, but it allows for a nice cushion, and that kind of de-risks you. So I think that's a really good way, a good route to look for. Other ones that have reoccurring revenue that people don't really think of are med spas, nail salons. So just for the women out there listening, it doesn't necessarily have to be kind of a male-dominated industry to find that reoccurring revenue. Another one that has almost 100% reoccurring revenue is daycares. So there's a lot of businesses out there with this beautiful reoccurring revenue schedule, and that's really going to help de-risk a lot of your investment.
I see. And do you focus on primarily these types of and these spheres, or you just kind of industry agnostic and you analyze different types of deals?
Yeah, so I have like 3 that I really look at a lot, and one of those is med spas. They don't come up very often, unfortunately. I also look at healthcare staffing, and that doesn't have the same amount of reoccurring revenue that HVAC has, for example, but it's pretty nice. And then another one that I look at is roofing, and those have maintenance contracts, which provide some reoccurring revenue. So I do like to say I'm industry agnostic, but there's ones that I do spend a little more time looking into.
And do you focus on searching the businesses in your area, or it can be just the online business? So you're basically situated in one state or in one town, and the business is in another.
A lot of people have different preferences for this. The southeast of the US right now is definitely growing at a much faster rate than the rest of the US. Part of that is from the tax advantages that the southeast have. So for anyone that's listening in England that may not or doesn't know, that includes like Florida, Georgia, the Carolinas. That's the southeast region there. And they have a lot of tax benefits that are really beneficial for businesses. And on top of that, they're having the highest rate of population growth. I would throw in Texas in there. That's not considered the southeast, but that's another state that's having a lot of growth. And it's I want to say the second largest. I'm not sure exactly. Maybe it's the first largest in population for state. Don't count my words for that, but it's a very large state for anyone outside of the country that doesn't know. Yeah. That's an area that I do like to look at right now, and I've done most of my search there. That said, search is very competitive, and I started out just searching in Atlanta, actually, which is the major city in Georgia. And but there's just not that many that come out of there, and so that is the downside of search. You don't have hundreds or thousands of options. You have a certain amount that come to market, unless you choose to do a search where you're going out and contacting businesses yourself, and you're not doing a brokered search. So I only look at deals that come to market through a broker.
So basically you're working with several types of brokers, and you're monitoring their websites, or you just receive the newsletters from them and you just look through the deals, right?
Yeah, I mean, it's a lot similar to finding real
Mhm.
estate and going through brokers.
Yeah.
So if you're familiar with Zillow, for example,
Yeah, yeah, of course.
I would say that the comparison to that is Biz Buy Sell. That site lists a lot of businesses, and then there's other software out there like Kumo or Axel that provide and all these different businesses, and they pull from all these different websites. But Biz Buy Sell is like the main one, I would say.
Yeah, it's really interesting. And actually, you can use these types of websites not only for the US, but also for Australia, Canada, and European Union as well. There are different websites for Europe where you can just go and check for the particular type of deals. We will put the links and the descriptions for those who are interested in that. And my question is connected to the length of the deal, because obviously, if we are dealing with a public market, you can actually invest the money just nowadays, and you can receive and start receiving maybe the dividends or the returns just right away. And speaking about the private equity deals, I think the situation is kind of different, right?
So typically it's going to be 90 days. So yes, it does take a little while, but you're going to write out a letter of intent with your
Hmm.
price and your terms. And then you're going to do due diligence,
Hmm.
which will take about 3 to 4 weeks. You know, the big thing with due diligence actually is really just collecting all the information that you need for due diligence. That can take a really long time if the seller isn't, up to speed with everything. But the due diligence itself, maybe just takes 2 weeks. So I say 3 to 4 because it takes a while to collect everything that you need. And then the financing and the underwriting. And if you are using investors, if you have that lined up beforehand, that's going to help, quicken the deal
Hmm.
because you're going to have them ready to go. If you don't have them ready to go, you have to go out and kind of do your pitch and find the investors for your deal. So that
Hmm.
can add a little more time. But yeah, I would say typically it's 60 to 90 days. 60 being best case scenario, 90 days being probably the average.
Just a minute of your attention, guys. I really wanted to share a little more information about our project Numfin. It is super easy tool for investors to analyze the company and get valuable insights about your current investments. We cover 30 years of financial data, and you do not need to spend a lot of time gathering the information about the company on tons of websites. Everything is available here on Numfin in one place. The information about the company, the competitors, the management, what are the financials, news, and much more. Don't waste your time. Go to numfin.com and register today. It is completely free for new users. The link is in the description. Do you use creative structures or creative types of purchasing? So, for example, like seller finance or maybe other things?
Yeah, there's a lot of creative ways to buy a business without even needing investors. So right now, the SBA just recently changed their guidelines,
Hmm.
and essentially you can have so for to buy a business with an SBA loan, I think you do have to be a US resident. Um,
Okay.
but you can and the SBA loan only works for in the US.
Hmm.
And then typically you can only do up to $5 million.
Hmm.
You can do a pari passu, and that's like you can go up to 15 million then. But like for this podcast, let's just talk about like the 5 million
Yeah,
aspect.
okay. That's fine.
So for that price, and
Hmm.
so you can take a loan up to 5 million, and the minimum equity required is 10% for that.
Hmm.
So the SBA recently, just this summer, changed the guidelines, and now you can do a seller note that will be on full standby for the first 24 months. And if you can do that, it will actually count towards your equity for the deal.
Oh,
So,
wow.
and so instead of needing $500,000
Hmm.
for a $5 million purchase, for example, you don't need that anymore. And so this is kind of it will be interesting to see how this pans out, because technically you may not need investors as much as you used
Yeah.
to, which kind of hurts the investors a little bit. They don't have as many deals then to put money into. But typically, even though there is this new rule, I mean, when you actually do go to a bank and talk to lenders, they still do want to see an equity injection. But ultimately, it's lowering the amount of equity that you need to put up for a deal, which is really beneficial. And if you think about it, I mean, 10% isn't really going to save you from going under if the business is going under. So, I think if ultimately what it comes down to is like, is this a good business? And that's what the lenders want to see. Like, does this business, has it been cash flowing? Does it have good history, etc.? And if it does, then the banks are going to want to fund that business because they're going to make money off of it as well. So I think that the idea of like getting more lenient about that 10% is really like a win-win for everyone involved. It means more people can buy these businesses. The banks can allow lending for more of them. And the only people it kind of hurts are investors. But typically for a $5 million deal, like the bank is not going to allow you to not put anything in. Like you're still going to have to put something in, but it decreases the amount that you're going to have to put in, which is really exciting. So that's one. You could also do just complete seller financing, which does happen, but it's typically not going to happen unless you find that off market. So maybe it's like someone you know, and you're like, hey, I'm going to pay you off for the next 5 years. But a broker is not going to be happy about a fully seller finance deal because they may not get their compensation then. So that's one thing you can do. And then there's just a lot of like, you can do a lot of tweaking with the seller finance. So you can have more than one seller note. So you can have one seller note that has that 24-month standby to count for 10%. You could have another 10% one that maybe has a balloon payment later on. So there's just a lot of creativity you can do with that. And then another thing you can do that recently came out with the SBA guidelines is you can now offer them equity. So when you buy the business, you used to not be able to allow the owner to have any equity after you took over, and now you can. So that's interesting. There's a little bit of a gray area with that right now on if those owners are going to have to sign a personal guarantee. Are you familiar with the personal guarantee? Yeah. So no one wants to sign those. So if you're giving the previous owner equity, the likeliness of them being excited about that is pretty slim if they have to sign a PG. So we're still like waiting a little bit to hear what the final details are on that. When they first came out, it was that they didn't have to sign a PG. Now it is they have to sign a PG. Still working out the details with that, but that is something that you can use to make your offer a little better.
Yeah, and now, as you said, there are more opportunities to these creative structures, and you can play with that in the models and during the negotiations. And my question is connected more about the risks of such type of deals, because obviously there are people who are focusing, for example, on the distressed assets or just on businesses which they can grow and scale and then just resell. How can you protect these risks when you understand that you purchase the business, but after purchasing, the revenue just fluctuates and the business doesn't go as planned?
So the seller note is subordinated to your bank's debt. If things go bad, you technically don't have to pay that seller note. There's not going to be like a repercussion. There can be, it depends kind of on what the attorney does. Like there can be, something where if you don't pay the seller note, the seller gets the business back. So that's more of like a legal question that I'm not super familiar with, but I do know that the bank debt comes first. So if things are going bad, then you're going to be focusing on paying that and not the seller note.
So basically you can negotiate with the seller that if something goes wrong, he or she can get the business back, and you do not own anything to the seller if the obligations are not met, right?
Yeah, but your obligation to the bank will always be there.
Yeah, definitely. If you have the loan from the bank, etc.
And one other thing you can do to protect yourself in that regard with the seller note is you can just write in the LOI saying, I will pay you, let's say it's a $500,000 seller note. I will pay you $500,000 seller note if the cash flow of the business meets let's say 1.5 million. So if the cash flow is at 1.5 million, I will pay you that money for that year, whatever 500,000 divided by 10 is. And if it doesn't meet that threshold, then I don't have to pay you for that quarter or that year. But once it comes back up to 1.5, I am responsible for that. The SBA doesn't allow you to do earnouts, which is something that bigger PE does do. And that is if you, let's say they made 1.5 in 2022 And an earnout would be if we make 1.8, I will pay you X amount of money. You can't do that with SBA guidelines. You can only do it based off of your historical financials.
Mhm. I understood that. And my question is connecting to your journey in the private equity. And what would you, if you of course would like to share that, what were your biggest goals or maybe successes and mistakes which you learned throughout your journey, which you can share to our audience?
Well, I'll talk about like maybe a mistake that I think is really important. And
Okay.
I have mentioned this before, but a thing that you really need to take into account is the integrity of the previous owner that you're buying from.
Hmm.
And the only way to really do that is to meet them in person. And with Zoom and all of these other ways to connect, you don't necessarily have to meet them in person until you take over the business per se. But meeting them in person instead of just talking on Zoom or talking over the phone is
Hmm.
very important. And I made that mistake. I was under LOI, took up a lot of time, and really the deal just went completely south after meeting in person because that person had a very different persona in person.
Yeah.
And you could see that effect on the employees as well. So that's something that I definitely think you should always do. You don't have to do it before LOI, but definitely before you sign anything or commit
Hmm.
too much time to a deal. Another little like funny story, I guess, of something that you have to be careful of are the non-competes.
Hmm.
And I put in a LOI for a med spa, and it turned out that the owner wanted to keep practicing injections out of her house. And
Oh, wow.
so essentially that creates a big problem because she can
Hmm.
just take the clientele that she's built up, not have any overhead and do it out of her house and
Hmm.
take the cash that I paid for the business. So you have to be careful with non-competes. And a lot of times people will say, hey, I'm retiring, that's why I'm selling this business. And that's not really why they're selling this business. So also just kind of getting down to the real reason why they're selling and making sure it's not like, hey, I'm going to retire, which actually means I'm going to take all the money, I'm going to take that $5 million that you just paid me, and I'm going to move 100 miles and compete with you, or 50
Hmm.
miles and compete with you. And I now have this great cash, bag basically to fund that and make it better. And they have all the skills and experience to do that.
Hmm.
So you have to be really careful with non-competes. And I've definitely ran into that more often than one would probably guess. So be careful with that. I think kind of something that really has helped me in this field is just, I don't want to pull the woman card, but I think being a woman right now is really great because there's not too many, but there's a ton of women owners, and
Hmm.
and and there's not a lot of women that are searching. Those numbers are increasing, which is great, but there's still not a lot, and that really puts you at an interesting place because you can relate a lot more to these women
Yeah.
owners, especially if they're talking to men all day from this PE background and they just want to talk about numbers and they don't
Hmm.
really care about building that relationship. So just being a woman is really been actually more helpful than I expected it to be.
Are there any resources or maybe videos or books you would like to recommend to start if someone from our audience would like to start this journey and just understand whether he or she can just continue that?
Yeah, I think there's some good foundational books out there. So Buy Then Build is like a very popular one,
Hmm.
by Walker. I may mispronounce his last name, Walker Deibel. So that's a nice foundational one for anyone that wants to search, not maybe using investors, just wants
Hmm.
to search and use their own funds to buy business. The other one that's a good foundation is the Harvard Business Review. And that one also talks about traditional search, which is where you're paid to search for a business.
Hmm.
You get a lot less equity in the business then. But anyways, overall, it's a great book to read. I think what businesses in that book they talk about are these unicorn businesses that you're never really going to find. So they kind of go through all the criteria of like what a business should
Yeah.
have, but you'll never find a business that has all of those characteristics. So it's a little bit of a unicorn book, but it's a good foundation. And then just being on Twitter, I feel like, or now it's called X, is actually a really great area to be. there's a big community there of people that really just post so much information that's so helpful about
Mhm.
searching for a business, but then also the operational side for a business. So SMB Twitter, even though it's now called X, is kind
Yeah.
of the hashtag area where you'll find just a really great, fantastic group of people with a lot of knowledge and experience.
Any final words you would like to share or tell to our audience before the finish?
Yeah, I think for like final words for the investment side, for people that are listening and they are
Yeah.
investors, if you haven't taken the time to really peek into investing in businesses, like now would be a wonderful time to get on that bandwagon, because there's so many people that are getting interested right now, and it's going to get more competitive as we kind of go on, and more people are educated about this. And it's just a great way if you want to just invest and not be at all part of the operations, you can do that. And you get really great returns that are much better than real estate. And in my opinion, the stock market. So that's a really just phenomenal vehicle. And then for the second part of like your audience, for people that are just interested in searching and buying a business, it really can be a life-changing event, in my opinion.
Mhm.
Because where else are you going to be able to, you can come and find a business without any money and get it from investors, and the investors get way better returns than they would normally. And you also get a chunk of that equity because you're willing to operate it, or you found that business. And that's just a life-changing event for someone that maybe only has $10,000 in their bank account, or 50,000, whatever the situation may be. You have the opportunity to really change your life and the outcome that you could have by finding a really terrific business. So it's a great path to go towards. And also, if you don't like your job right now, you can go out there and find out what is your passion, and then buy a business in your passion area, and you have the opportunity to do what you love every day. So that's another wonderful benefit.
Yeah, fantastic words. And we will definitely put all the links which we discussed about this episode. And we also put your contact information in the description. So if anyone from our audience or listeners would like to sell their businesses, you can always write to Whitney and discuss about that. Thank you for your time. I really enjoyed the conversation. I hope it will be also beneficial for our audience as well. And thank you. See you next time.
Thank you. I had such a great time. Thank you so much for taking the
Bye.
time to talk to me. I appreciate it.
That's all for today, guys. I hope you really enjoyed the episode and found it useful. Don't forget to subscribe for more. Check out numbthing.com and see you next time.